Welcome to the STR Data Lab.
Hello and welcome to the STR Data Lab. I'm Jamie Lane, Chief Economist at AirDNA, and I'm joined today again by my trusty co-host, Scott Sage. Scott, good to see you again.
Great to see you, Jamie. It's a big day today.
It is. We are here today to talk about 2026 best places to invest, which is, as I've mentioned before, my least favorite report that we do every year.
Maybe that's why we skipped the drum roll.
But it is the most popular report that we do every year. So
are you preparing now for your inbox to be flooded?
I get all sorts of love, hate. Why did you expose my secret market that I've been investing in? Like, you're an idiot. There's no opportunities to invest in that market. Like, it runs the gamut of feedback that we get from it.
Well, I'm confident you're going to get some of those messages with this list we're going to reveal today. So there's a teaser for you. But Jamie, we will do our best to explain why these markets show up on the list to maybe help clear 5% of those messages for you.
Oh, I love all the feedback. My email, if anyone wants to send feedback, is scott.sage@airdna.co.
There you go. All right, great. I have email forwarding set up. All right. Well, what do you say we get into it?
Yeah, let's do it.
All right, Jamie, let me actually start asking you a pop quiz question here. Fact or fiction, 2026 will be the best year to invest in short-term rentals since 2022.
I think that's true. And that is a output of our U.S. Outlook report. So I know that you have read it, mostly because we did a podcast about it. But also, it has not been a great few years for short-term rental investment. Home values have been extremely high in relative to property incomes and really in everyone's incomes. Interest rates have been uncomfortably high as well. So the cost of debt has been the highest we've seen in really much of our lifetimes, and us being on the still consider us pretty young, right?
I like to think so.
Yeah. So maybe high in our investing lifetimes. And then it's been a wild ride for short-term rental performance. Like, overall revenues are down from highs in 2021 and 2022. So you combine all that, like, it hasn't been a amazing time for finding deals. And there's still deals to be had. And we all know I found a property in 2024, and it's doing remarkably well. So it's all about market selection. It's all about property selection. I think that still continues to be true, but I think on average, things look a bit better in 2026.
Yeah, we're talking averages here, and that's what we can really only do here at this like macro level. And the best heuristic, I think, or like maybe single data point to look at is this STR investment premium. So we talked about it in the Outlook report. This is a great metric you have here. And when you look at that, so basically the difference between what a typical, so-called average short-term rental earns compared to what it costs to finance, so your debt service, we're seeing that at the highest mark since the end of 2022. And we are forecasting that that's going to continue to grow in the subsequent years.
Yep. And that incorporates our forecast of short-term rental revenues, what we expect to happen in terms of occupancy and ADRs. It takes into account what do we expect to happen on home values, and it takes into account our expectation on interest rates. So we do expect some relief, especially in many markets on home values, either flat, in some markets declining, and we're seeing that today. And we do expect interest rates to come down slightly, and short-term rental revenues to appreciate some. So all that equals slightly better returns.
Directionally and very market dependent. And that's why we're making this list. Like, I know you don't love the list because there's so much variability.
Yeah.
I like the list because it actually demonstrates the work and exercise you should be doing as an investor. You should be underwriting for your particular market or submarket, city, zip code, what the variability looks like, what the opportunity set is, what you can actually invest in today, and what you expect to earn. So it's sort of like a, hey, do your homework reminder if you're going out to invest. So without further ado, let's talk about that. Let's talk
Yeah.
about how we create this list. So what is the methodology behind ultimately the prompt of where can you buy a short-term rental property today that's likely to perform well tomorrow?
Would you kill me if I said I started with a map of US and just started throwing darts, and that's where we ended up?
Don't reveal our secrets.
No. So this list has evolved as our data has evolved within and what we have access to at AirDNA. So years ago, when we first started doing this list, it was essentially based on averages of home values that we got from Zillow, and it was really representative of the average and potential investment opportunity. And then and a lot of the criticism, you go into those markets and like there weren't actually any good deals. So that's where we start now with essentially just aggregating every potential deal in the US and what's good and what's bad. So we now have access and bring in every single home available on the MLS. We're then running a rentalizer estimate on every single one of those homes. So going out and finding nearby comps, what are they earning as a short-term rental, and coming up with a revenue estimate for every single for sale home in the country. So that's roughly 500,000 properties, and then using all that to bring it together. So aggregating it up by market, by submarket, as we can do in the app, AirDNA app, and seeing which ones then have the best yield. So that is in yield defined by and what is the average revenue and revenue potential of that property divided by the price that it would cost to acquire that asset, and we're assuming the for sale price.
And Jamie, that's a really important point because that drives a lot of this ranking is a key metric. What is a good benchmark we should be thinking about for a yield number?
Yeah. So when I'm looking at investment properties, I'm starting with a base of like 10%. If it doesn't have a 10% yield, it's not going to make it through my initial filter. A good yield is going to range and probably from 10, 15, 20%, depending on the market, depending on the price point. I would say yields can get lower, maybe in the upper tens, at higher price points. So if you're investing more than 500,000 or $1 million, like maybe and below that threshold of 10% is okay. If you're investing below maybe $400,000, then you might look on the upper end of 10, 15% is going to be more needed to generate a reasonable return on that investment.
And there's different thresholds of tolerance for every investor, depending upon what you want to use the property for. Is it pure cash flow? You're probably going to be laser focused on yield. Do you want to use it part of the year and you just want to offset your mortgage, right? The yield is still a very good metric for you to understand directionally what it can for how it can perform, but you may not care as much if there's some personal use in there. Okay, so that's how we do the analyses. It then really drives to three key metrics, Jamie: demand, revenue, and investability. Can you explain these key metrics and how that influences the list?
Yeah. So I'm going to start with investability because I just described that. It's essentially taking the gross yield of the properties, looking at that sort of index across all the markets and ranking that factor. So it is a pure yield metric on an aggregate of all for sale properties available in that market. So that's the first. Demand is probably my favorite metric because it combines two. So it starts high level with just occupancy. So out of every night that was available, how many nights were sold in that market? So high occupancy markets like and in Hawaii, like in South Florida, like we're looking at 70, 80%. Low occupancy, you get much more seasonal markets, like maybe some of the ski resorts or beach markets, where you have a super high season, you have a super low season, you're selling out during high season, you're selling nothing during low season. Yes, those markets are investable, but they take a bit more effort to make cash flow and to round out overall performance. And then also in there is a year-over-year change in book nights. So for me, that's a metric of like, all right, just high level, Scott, like, are more listings being sold this year than last year? Because if I'm investing into a market, it'd be great if there's that positive momentum of more bookings happening versus less. And that is also a similar sort of metric that we see with RevPAR. So we're looking at year over year change in RevPAR, and that's our revenue metric. So it does give us a sense of momentum. Not only is it getting booked more, but are properties earning more or less than they were over the prior year? And so that incorporates pricing. Are people charging more or less over the prior year? And in general, when I'm looking at investment properties, if you're looking at a market that's seeing declining RevPARs, that has to go into your underwriting of the current yield might not be sustainable. And the current trend is showing that it's probably not sustainable versus a market where RevPARs are increasing, where you might be able to underwrite decent revenue appreciation in that market.
And then the big one, number 4, what about regulation?
Yeah. So regulation, we don't use explicitly in the rankings, but we do use it as a disqualifier. So we do research the regulation for every market on this list. It's really easy now with a lot of the different AI tools, really easy with and sort of Googling around and sort of understanding what the regulations are. And as long as new investment is essentially not banned. Like if there is a decent opportunity that you can at least go through the process of getting permitted, getting a business license, we'll include it on this list. If it's like a market like Maui where you just, yeah, and there is not a possibility of getting a permit to operate in that market, we're not going to include it.
Okay. All right. I think we have our foundation to go into this list, but one more setup and teaser here before we get to the big reveal. We've done some new things this year, Jamie. We have some new cuts of data beyond just that flat best places to invest list. We have budget tiers. So by box, like we said at the start, everybody's in a different situation. So we wanted to look at best places to invest based on different price points. And then we also have demand drivers new this year. Tell me about demand drivers.
Yeah, so demand drivers is a new feature in our app for finding markets to invest in. It's essentially a market filter. So what we've done is we've driven into and what are some of the main reasons why a guest chooses to visit a specific location, be it ski resorts, universities, national parks, military bases, and lets you sort of build an investment thesis around different types of demand drivers. I really love these because so many investors I talk to like come to me with this thesis of like, Jamie, like I'm crushing it in university markets. Help me find other university markets that are doing well because this is working for me. Or like I really have seen strong demand around national parks given this propensity of people to want to go out and enjoy the outdoors. Or I am a beach market only investor. Like I love accommodating families. I love the high ADRs that people are willing to pay when they go to the beach. They're staying for a week at a time. Like that fits my buy box in terms of the type of guests I want to accommodate and what properties I want to invest in. So this is really a way for people to go into our app and find markets that meet that demand driver, and then be able to narrow down and find those markets that they're looking for. So given all that, and given that you've seen them, Scott, like what is your favorite demand driver?
Look, I'm in the Bay Area, so I'm not far from wine country. I think mine's winery.
Scott, I asked your favorite market type, not your favorite drink.
Oh, sorry. We're getting close to happy hour, I suppose. I actually really I like the university play.
Yeah.
So we'll talk about some of these. There's some notable universities on this list. What about you, Jimmy? Do you have a favorite demand driver?
Yeah, mine is definitely national park. Even though when I did invest, it wasn't near a national park. And if you can profit off our country's natural beauty, why
That's
not?
always a win. There you go. That's the headline of this year's list, I guess. All right. Well, let's get into the list. What do you say?
Yeah, let's do it.
All right. Number 5, Springfield, Illinois. Number 4, Charleston, West Virginia. Number 3, downtown St. Paul, Minnesota. Number 2, Abilene, Texas. And number 1, Jamie, I'll let you do the big reveal here. Number 1 on the best places to invest 2026.
Yeah, it's also in Texas, Port Arthur, Texas.
Man, you had a lot of energy around that one.
Oh, yeah.
All right, so why don't we start there? Let's start at the top. Maybe not what people think when they think of a short-term rental. Oftentimes people conflate short-term rental with vacation rental. So you could argue, I'm sure there's some listeners saying, I love Port Arthur, Texas as a vacation spot, but may or may not be true. So let's dissect what's going on here with the top 2.
Yeah, and this is a theme we've heard or we've seen in the data over the past couple years as home values have risen. It is, and especially in some of the more traditional vacation rental markets, that it is become much tougher to invest in them and drive a return. And I think the list reflects that a lot of the demand, and yes, is still coming into some of these are into these traditional vacation rental markets, but the investor activity has decidedly shift away from these traditional vacation rental markets. So in 2025, the top location type, so we break out the country into 6 location types: urban, suburban, mountain, lake, small and mid-sized cities. Small city, rural, and mid-sized cities have been the top supply growth location types for now 4 consecutive years. And now for 4 consecutive years, we have seen small and mid-sized cities really dominate our top market to invest list. So it's not to say there's not great investments in some of these coastal and beach markets, which we will talk through. But markets like Port Arthur, which has a big port, and it does support a lot of the oil and gas industry. Abilene, like so much of our economy, we've talked about and extensively on the podcast, the K-shaped economy, and how much of the economy is being driven by AI and economic growth is being driven by AI. Abilene is front and center for that, where there is a Project Stargate being built, which is this massive data center project. We have seen RevPAR growth of almost 50%, and occupancy has exploded. You just Google Abilene, Texas, and like top thing is like hotel occupancy through the roof. Like, and people cannot find lodging that are there doing work on a lot of these infrastructure projects. And short-term rentals have done really well associated with that. So it's not to say that growth is going to continue for Abilene, but I think it's a great example of putting yourself in front of a tailwind like infrastructure, whether it's ports and exports, whether it's AI and infrastructure. This is how and why the economy is growing right now, and finding investments and finding markets that are going to be beneficiaries of that is a great strategy, in my opinion.
Yeah, I mean, these two are a textbook example of high yield investing without a high price tag. I mean, you look at number 1, Port Arthur, the average home value is $243,000. You look at Abilene, it's $336,000. And to your point around the tailwind, you think about just, okay, if you're going to invest in short-term rentals, you should have a point of view on who's staying in your property. What is the demand driver? We've been talking about demand drivers. Maybe we need to put Project Stargate or AI as a demand driver.
Yeah.
But it's in both of these, it is construction, right? There's a large oil refinery in Port Arthur, and it seems like there's even more construction coming into the city. And so you have people booking extended stays. And I think we saw a growth in the average stay length in Abilene and Port Arthur year over year as well, which again reinforces who's coming here, who's staying. Yes, it's not necessarily your typical sexy vacation rental market along the coast, but it delivers real compelling yield at a low price tag. And so that's actually why I really like this on the list, because it signals the power of underwriting and the power of data and smart investing. It's not for everybody, but this does do a good job showing that it's accessible even at different price tiers.
Yep. I agree.
All right, let's talk. Any of the other top 5 stand out to you, or any key data points you wanna call out here, Jamie?
No, and there's others that are sort of perennial favorites for me. Springfield's been on the list multiple times. I think Montgomery, Alabama, is a market that has been one of my examples of just like a great mid-sized city to be investing in. A lot of different demand drivers coming into that market, university and small tech. They've got a waterfront, our riverfront, Riverwalk, new breweries popping up. Like it's a market that doesn't seem like it's high leisure oriented, but there is a lot of leisure travel coming into it. Not necessarily like, oh, I'm going to go vacation in Montgomery, but I'm going to go visit friends and family. I've got a reason to be there. And short term rentals are decidedly a preferred option for staying in when you're visiting a market like that.
Yeah, and so you're talking about number 7 on the list. I will just quickly round out the top 10 here. So number 6, Lake Charles, Louisiana. 7, Montgomery, Alabama, as you were talking about. 8, go back to the Midwest, Akron, Ohio. 9, Lebanon, Pennsylvania. And 10, Jackson, Mississippi. Interestingly here, Jamie, only one market, Abilene, Texas, has average revenue potential of greater than $50,000 a year. Abilene's at 55. The rest are in the high 30s, low 40s on this list. And so when you think about where to invest, what is driving yield, right? Again, we come back to this investability score, how important that is as part of this analysis.
Yeah, and we're going to get into, I think, next on different top markets and based on price points. And there I would point out that a lot of the lower price point markets are going to look very similar. Like we're going to see in some of the markets repeated, and for good reason. Like highest yield comes at lower price points. But there are, I think, a lot of really interesting markets also at these higher price points where it's not as high of yield, but still amazing investment opportunities to generate cash flow.
Well, let's go there next. Let's talk about these categories of price tiers. And we've already talked, we can talk about the 100 to 250,000. So for context, we have 6 different price tiers, 100 to 250K being the lowest, and 1 million to 5 million being the upper bound of these buy boxes, if you will. So total home value. Jamie, you want to start in the lower? Where do you want to go?
Yeah, we'll start with the lower, and I'll give some data points that sort of give some overall context of what we did here. So when we're looking at these different buy boxes, so 100 and 250K, number 1 is Montgomery, Alabama. But what we're doing here is limiting the properties to just that range, and then looking at the yield for those properties. So where on our overall list, Montgomery had a yield of right around 12%. When we look at this range of just properties for sale between $100 and $250,000, the yield averages out to 21%. So a lot of the yield potential in Montgomery is being generated by those low home value properties. And so you get to actually a lot of in either South or Midwest. So we've got Montgomery number one, Jackson number two, the Finger Lakes number three. So up in upstate New York, you've got South Bend, Indiana, and you have Rochester, New York. So a good mix of different properties. If you're able to find a property in the Finger Lakes at that low price point, you're probably not on the lake, you're probably just off, but able to provide a reasonably priced option for someone that wants to go vacation in that region.
Well said. Well said. I think it's a very important distinction if you're looking at if you're going to be comparing these two lists, because Montgomery shows up twice. I just want to underscore what you're saying. This price tiers analysis is looking exclusively at the home values of 100 to 250,000.
Right. And this can also help sort of narrow in like where the opportunity might be for those different markets and what price points you're looking at. Because when we look at the next one, $250 to $400,000, number one is Abilene. So you did say that, and the average revenue potential was the highest in Abilene, and a lot of the opportunity is in this next tier of price point. So average yield of 18.5% at an average home value of $307,000. So if you're looking lower, Montgomery might be an option. If you're looking a little bit higher in terms of price point, Abilene. We also see Burlington, Kentucky, strong, Savannah, Georgia, Columbia, South Carolina, and then the Maine beaches, which is a market just north of New Hampshire on the coast there in Maine. So before you get up into the Acadia region, there are some great sort of beach markets on the coast up there in Maine.
Jimmy, let's jump up to maybe the top two price tiers. So 700,000 to $1 million. What do we see here in the top three for this list?
Yeah, so this is an interesting segment because you do get into some of the more popular markets for investing right now for going into more traditional vacation rental markets. So number one is Santa Rosa, Rosemary Beach. So the 30A region area of the Panhandle of Florida, average yield of just under 10%, 9.8%, average price point of $850,000, revenue potential of $83,000. So great opportunities down there in Santa Rosa. Number three is the Ozark Mountains. Our two is the Ozark Mountains, and number three is Fort Lauderdale, Florida.
Very classic vacation rental locations there. And then $1 million to $5 million homes. What do we see here?
Yeah. So here I want to go through maybe the top five because we do see a wide range of markets. We do get in some big urban areas with DC, Washington, DC being number one, an average price point of $1.6 million, revenue potential of 100,000. This is a market that has seen some home price volatility with Doge cuts leading to some layoffs in the DC area, but also a market that sees a lot of transient activity, people moving in and moving out based on any new administration. We did see that being a big driver of demand in 2025 as the new Trump administration came into the market. A lot of people looking to and for short-term rentals for temporary housing. That is a continual demand driver in that market, and people really looking at really high price point, nice properties to do that. San Diego, number two, Colorado Springs, number three, Miami, number four, and then near you, Napa Valley, number five. Only an average yield of 5.5%, but those are properties, super high price point, over $2 million, generating revenue of well over $100,000. So maybe some opportunities for investing if you've maybe invested in crypto or have some great stock options if you work in NVIDIA.
That's the Bay Area flight to Napa right there. So I think what this does is it showcases the power of the data that we have, regardless of your starting point, and I mean starting point meaning you may start with a certain dollar amount you're willing to spend on your property and all in expenses, and great. Okay, now I can go look at where could I direct my investment at those certain price points. And then maybe you want to add a geographic layer to it. Maybe you want to add a yield layer to it. Then, which we're going to talk about here in a moment, maybe you want to add a demand driver layer to it. So maybe you want a home that is $500,000 to $700,000 near a winery, right? That we're getting really specific here. There may be one or two homes available, but it shows the optionality and agility you have with this data. And that's why we're doing the rankings this way. So let's go there next, Jamie. Let's talk about the different demand driver list we have here. Maybe let's pick a couple. You liked national parks. Why don't we start there?
Yeah, so interesting national parks for investments, and these are going to trend more towards some of, and a lot of these lists are more towards some of the more affordable different price points. So national parks, we've got Ridgecrest in Oakhurst in the Southern Sierra Mountains, near both Death Valley and Yosemite, generating average yields of just over 12%. You've got Pineville near Cumberland Gap, and then you got 29 Palms near Joshua Tree. So all generating above, on average, 10% yields and pretty attractive price points. So all of those markets having average home values below $500,000.
Yeah. And even if you look at these top two, right? I mean, we have how many at the time of this data cut, how many for sale listings are available?
Yeah, in Ridgecrest, there's almost 60 listings, so lots of potential. You go down to somewhere like Mammoth Cave National Park around there, and over 80 listings on average, $270,000. So,
There's real potential here.
yep.
Okay, why don't we pick one more of these? Let's look at, we won't do airport. Let's do university. Everybody can kind of recognize some of these university names. Maybe a bit of a common theme here with some, but why don't you take us through the top 3 or 5?
Yeah. And what's your favorite university again?
Purdue. Boilermakers.
Boilermakers did make the list at with Indianapolis at number 6. My home university, University of Georgia Athens, did not make the list, but we did see Columbia, South Carolina, number 4, University of South Carolina. We saw Syracuse up in upstate New York up at number 3. We saw East Lansing, Michigan, Michigan State University, where my dad went, at number 2. And then University of Notre Dame, South Bend, showing up again on the list as number 1.
That's about the only time I'd like to see Notre Dame number 1 on any sort of rankings as a Purdue fan.
Agreed.
But no surprise there, right? I mean, Notre Dame draws in a lot of people for more than just sports, but 8 weekends out of the year, they're filling the city for football games. But this is a good example. I mean, you're right. We hear it at conferences. We hear it talking to customers and partners and other investors. University is a strategy people take and can execute it well. And in most of these towns, approaching or even over 100 listings available for sale. So again, real opportunity here.
And something I love about university markets, yes, you can get the premiums on game day weekends, but you also have professors. A lot of these have university hospitals driving residencies and midterm stays with hospital workers, people looking to come for treatments, cancer treatment, surgeries, looking to stay in short-term rentals, and then parents visiting their kids. You've got and grad students coming for 2 to 3 months at a time. So there can be so much demand associated with the university that aren't always just driven by football or basketball or any of the sports related, but those are amazing for driving additional profitability and getting the premiums that you can garner on those game day weekends.
It's a lot of fun digging into the different demand driver opportunities that exist here, overlaying it with the buy boxes. So, Jamie, I'm going to go spend the rest of this week digging into this list, and we're excited to release it this year, the 2026 BPTI Best Places to Invest. What's your final recommendation here for listeners on how to utilize this list and how they should be doing their own research?
Yeah. And the thing, and I'll sort of couch my statement that I started with that I hate this report, uh, is thinking about and how and why we do these lists, is to get people thinking about maybe going outside the box in terms of not just investing in your backyard or maybe always investing in that market that you grew up visiting. That there are so many markets out there that you could find that's going to drive incremental returns that are going to be your next great investment. And what we wanted to highlight is different ways to think about it. So, different price points for investment, different demand drivers for investment, that it's not always just yield, that other metrics like occupancy and RevPAR growth should and could inform how and why you're investing in different areas. And that and bringing all that together and forming an investment thesis, I think it's the right way to go about it. I would not suggest, like, this is not investment advice. I would not suggest, Scott, that you go out and invest in Port Arthur, but maybe use the framework that we've used and developed to find Port Arthur, to find your next investment opportunity yourself.
Very well said. And kudos to you and the team, the full team at AirDNA for compiling this. A lot of work goes into this analysis and research and production of the reporting. So great work and kudos to the AirDNA team.
Yeah. Shout out to Camilo, who dove in heavy with me this year. It was a lot of fun.
Awesome. Thanks a lot, Jamie. This was fun.
Yep. Thanks, Scott, and happy investing.